Hello, good morning. Today our guest is Matthew Tuttle. Hello, Matthew. How are you doing?
I'm good. How are you?
I'm great, Matthew. So, Matthew, I've been following Tuttle Capital for a while. What is Tuttle Capital?
So Tuttle Capital is an ETF issuer. We issue ETFs both that we come up with, and we also issue ETFs for other money managers who we think have a good product, a good idea. A lot of ETF issuers out there say that, well, we're innovative, but we take innovative extremely seriously. So we try to come up with, ideas that are really first to the marketplace. And that's really what we specialize in.
Matthew, list some of your offerings and explain for us what is an ETF.
Sure. Well, and I'll start with what is an ETF. So an ETF is what's called an exchange traded fund. So basically, just like a mutual fund, it's a pool of stocks or bonds or other ETFs or swaps, some sort of financial instruments. But unlike a mutual fund, they're traded on the stock exchange like a stock. So you can buy and sell shares of an ETF all day. You have no 60-day restrictions. You can do limit orders, market orders, VWAP. So you've got a lot more flexibility, which is why ETFs are, slowly making mutual funds dinosaurs. We have 10 ETFs right now. We've got a couple others that are going to be coming out within the next couple of months. 5 are our own ideas, and then 5 are for other money managers. Our most popular ETF right now is a ticker symbol SARK, which goes the inverse of the ARK Innovation ETF, ARK-K. Our second most popular ETF, which was also a first to the market, is SPCX, which invests in pre-merger SPACs. Then we've got SOGU, which goes inverse, an index of companies that have come public through a SPAC merger. We have FOMO, which is our trend following ETF, fear of missing out. So we want to hop on whatever the latest trends are. And then we have DSPC, which goes long the stocks that SOGU goes short.
So Matthew, I plan to talk about ARK Innovation, but we're going to discuss ARK Innovation later in the interview. Presently, we're going to talk about important terms because this show is about education. What's a SPAC?
So a SPAC it's short for Special Purpose Acquisition Company. Basically, what that means is it's a blank check. So you give some sort of investor, a venture capital guy, a private equity guy, or, someone with a lot of corporate experience, $10. That $10 sits in a bank account for typically up to 2 years, and they start looking for acquisition candidates to take public. If they find a deal and someone agrees to go public through the SPAC, you get to vote. You can either get your $10 back if you say, hey, I don't like this deal, or you can vote in favor of the deal and stay invested in it. So companies like DraftKings, Nikola, Lucid Motors have all come public through SPAC mergers.
And why are SPACs becoming so popular?
Well, they were so popular. They're definitely not as popular as they were, back in the whole meme stock craze, because, basically back then, it was a novel idea. They were taking really innovative companies public. They're still taking innovative companies public, but back at the beginning of last year, there was a real high multiple placed on those types of investments. Fast forward to today, they have lost a lot of popularity. But what we talk to people about SPACs is actually using them as an alternative to where you would have traditionally put bonds in your portfolio. So, remember, bonds, some people use bonds for income, but at these interest rates, that doesn't work too well. So bonds historically have been a risk reducer to a portfolio, something that's not going to move the same way as stocks do, and something that, can reduce overall risk. Bonds have been getting crushed because of what the Fed's doing with interest rates. A pre-merger SPAC, I can buy it below 10, and no worst case scenario, at some point I'll get $10 for that. So we really like it as a bond alternative. The industry is starting very slowly to catch on, but I would expect that to get more popular and interesting, over over the next few months as the Fed continues to raise rates.
Matthew, talk some more about the Fed. I've been reading a lot of articles on the Fed and interest rates and inflation. What's really going on?
So what's really going on right now is a whole bunch of nothing. So, the Fed saying, hey, we're going to raise interest rates, and they just raised them 25 basis points, which, is a rounding error basically. But at the same time, they continue to flood the economy with money, and they have not stopped doing that. So right now there's a lot of, the Fed's going to raise interest rates. The Fed, nothing is happening, and we'll see whether they've got the guts to actually do it. They're between a rock and a hard place right now, because one of the Fed's main policies is controlling inflation. And inflation is, just go to the pump. Tell me we don't have inflation. Go to the grocery store. Inflation's out of control. And so one way the Fed tries to control it is raising interest rates to slow the economy down, which again, it doesn't help when you raise rates, but you still continue to flood the economy with money. The other issue is if you raise interest rates too far, too fast, you run the risk of putting us in a recession. So it almost seems like they're in a holding period here. Try to say the right things, but don't do anything and hope the problem fixes itself. So, chances are this is going to come and bite us in the butt at some point later on this year.
Carl Icahn is predicting a recession, and as we all are aware, inflation is no longer transitory. But Matthew, I've been paying serious attention to the venture capital market in America. It's really hot.
Yeah, things are starting to heat up again. Certainly a recession is a possibility. We always, as money managers, like to keep an open mind and look at everything without bias. So I don't come at it from, hey, we're going to enter into a recession. But, I've got an economics degree. I'm looking at the numbers. I can't disagree with the possibility that we do enter a recession here.
But Matthew, suppose we don't enter a recession, maybe we'll be forced to revise economic theories. And this is what I am predicting. I like to make predictions. I think that the economy is changing at a fast rate. Just look at how capital is created today. Someone in his 20s, let's say 25 or 27, he starts a business with his friend, and for 5 years they run the startup. Then the startup goes public and they become billionaires. Whereas 50 or 70 years ago, you would have worked at a manufacturing company for 20 years before you earned the millions.
Yeah, the economy is constantly changing. What you brought up is a great point. Look at crypto. Where does crypto fit into this whole equation? The transition at some point to clean energy and away from fossil fuels, where does that fit into the whole equation? What's going on with Russia, where a major superpower's economy has been isolated from the rest of the world? You've really, understanding history and understanding what worked and didn't work in the past is extremely important, but you've also got to have a real open mind to what's going on in the future.
The Russians and the Chinese, they devised an alternative payment system to the SWIFT system, and it is obvious that Vladimir Putin can never be faced by sanctions.
Yeah, what's going on there is going to have ramifications that last well beyond this whole current crisis. And, what's going to go on with China? What's going to go on with China and Taiwan? It just makes for an extremely interesting and treacherous environment. And one of the reasons why, as an ETF issuer, we want to keep kind of coming out with tools that allow investors to manage the risks both to the upside and the downside.
And then we can never forget that as a region, Asia is quite contentious. India, Pakistan, and China, they're not necessarily friends. China, like America, doesn't have real allies, just interests. So we don't know what will happen in the Eastern region within the next 2 or 5 years. China, the rise of China is greatly resented.
Yeah, it's a dangerous world out there. So where's Russia going to stop? What's going to happen there? Again, China. I mean, interesting that India sided with Russia in a UN vote. So, a lot of stuff, what's going to go on with Europe in defense, where for, the whole post-war era, we took care of Europe's defense. Now they're ramping up those budgets. What does that mean if the European countries get militarized? And not just the next 2 to 5 years. I mean, the next 10, 20, 30 years, what's the world going to look like? All interesting stuff.
No, crypto is a risky asset. When you talk about investment, it's usually good to have skin in the game. So whenever I speak about Roblox, I say to people, I actually bought Roblox. I'm yet to buy crypto, but is crypto really a better store of value than gold? There's some conversation about crypto being a store of value superior to gold.
No, so it's not as monolithic as that. So crypto is a lot of different things at a lot of different times, as is gold. I mean, a lot of times something will happen in the world and you'll think, all right, gold's going to go up, and it goes down. So, gold's a weird asset. Crypto's an even weirder asset. So sometimes it's a store of value. Sometimes maybe it's inflation protection. Sometimes maybe it's, a dollar alternative, a gold alternative, but it's almost always a risk on, risk off asset. So, in a lot of ways, it ends up getting correlated with technology stocks, which is, in our mind, the main reason it sold off so hard when all the technology stocks sold off. It also is starting to look right now like it's percolating with a lot of the technology stocks where, at least in the short term, it looks like it may have found a bottom. I don't know about intermediate term or long term, but we've actually started buying some blockchain stocks and may continue to do that if we like the way that crypto is looking. Not as a long-term investment, but short-term, I think there's some good opportunity.
Matthew, now we're going to talk about meme stocks and retail investors. What's your take on the GameStop saga?
So it came back, which was somewhat interesting. I worry about the retail investor whose entire experience of the market was kind of, post-COVID. I think there are a good amount of similarities between them and the retail investor, back in 1999, whose entire investing experience was the late 90s. And I think you run the risk of not really learning how markets work. And we're very active on Twitter, and, I communicate with a lot of people. I see what's going on. And, you had a lot of retail guys making a lot of money buying the dip that all of a sudden, as soon as the Fed came out and said, hey, inflation's not transitory back in November, sorry, that really changed the whole buy on the dip equation. And if you've been in markets for years and years and years, there's a difference between buying the dip in an upturn and buying the dip when the Fed has your back versus buying the dip in a downturn and when the Fed doesn't have your back. But I think a lot of these retail guys didn't. And I saw a lot of guys get crushed. We're seeing some of that stuff percolate again, which, I struggle to decide whether I think that's a good thing or a bad thing. I think you got to understand how markets work before you can really, you can make money off this stuff, but understand how markets work, understand that this is not normal and it needs to be treated as something that's not normal. So, a GameStop is not a long-term investment. It's a trade. If you treat it like a trade, if you treat it like that with proper risk management, stops, scaling in, scaling out, then fine. If you're dumping all your money in it, thinking it's going to make you rich, that's going to cause some problems.
Matthew, maybe retail traders are revealing to us that value in the marketplace is actually quite subjective. That was my first take when I saw the GameStop craze. But we're talking about retail investors and meme stock. EV, do you have a particular position on EV and companies like Rivian?
So, EV, obviously, we know that's going to be the future. Just like every industry, they're going to be winners and they're going to be losers. Rivian seems a little bit overinflated to us. All of them seem, not as and we're looking kind of where the investment opportunities today, like right at this moment. So I think in the future, EV is going to be great. Again, you want to be, in the winners and not the losers. We don't own any EV stocks today. That's not to say we might not own them on Monday or the next day. We just see, a lot more opportunity on the growth side in semiconductors and cybersecurity, and then on the value side and, energy and commodity stocks. At some point, if this bounce, is real, then I think you'll see a lot of the EV stocks picking up. I wouldn't be shocked, given what Tesla's done, if we don't own Tesla again at some point soon. But yeah, so short term, we're not in anything. Long term, it's the future.
You're right, Matthew. Innovations will take some time to scale. So I was having a conversation with a management consultant and he said, an EV is a brilliant concept, but because of its future potentials, people are bullish and they're investing in EV companies. But based on the data that I have been reading, the average man is not necessarily crazy over EVs. And it's a good concept, but it will take time to scale.
Well, without a doubt. I mean, I'm a good example. I'm 53 years old. My whole experience in life has been fossil fuel cars. I know I can drive anywhere I've got like 4 gas stations within a minute from my house. I don't know how where do I charge a Tesla? If I'm driving like in the middle of the desert, what happens? I haven't wrapped my head around that yet. And I think a lot of people are probably in a similar situation where, maybe people your age are totally comfortable with it. I'm just not there yet. Yeah, I think you also brought up an interesting point about innovation. Remember, it's not just that you need to be innovative, you need to stay innovative. And I think a lot of people miss that point. Hey, I'm invested in XYZ because they're innovative. All right, great. They're innovative today. But, they've got, a bunch of other competitors. They've got to stay innovative. And, when things shift, they've got to be able to shift with them. History is littered with companies that were innovative when they first came out and no longer exist.
Several companies, just look at the retail sector. Walmart is still standing. Nordstrom is still standing. Publix is still standing, but many of them
but all the retailers I grew up with are gone.
Look at Walmart. Walmart's strategy is really organizational efficiency. The low prices are a consequence of organizational efficiency. Sam Walton was serious about management. So I will put Sam Walton in the category of a managerial innovator. And today we tend to focus on product innovation and less on process and managerial innovations.
Yeah, no, I mean, Walmart's definitely innovative. And if you look at the retail space, I mean, the leader from an investment standpoint, it's Costco. So yeah, I mean, there's definitely some innovation there. And you saw the companies that couldn't innovate, they're gone. Like I said, all the retailers I grew up going to no longer exist.
But what is Costco's advantage? Because the last study I saw said that the average customer of Costco is an upper middle class Asian woman. So obviously Costco is not as cheap as other retailers. So what's Costco's advantage?
So I'm not a fundamental analyst, but I am a Costco customer. I'm not an Asian woman, at least not today. And I can tell you I'm a Costco customer because it's a whole heck of a lot cheaper for me to go and buy a whole bunch of stuff in bulk at Costco than run to the grocery store every day or every week. So it saves me money. They have almost everything that I want. So I very rarely have to go to the traditional grocery stores. But I mean, that's just one guy's experience. Looking at it from a technical standpoint, which is how we look at things, clearly, and we don't own it today, but it's something that we may own if it starts to break out. But looking at it from an investment standpoint, it's the only retailer that we touch at this point.
All right then, Matthew. So this is what I'm getting from you. Maybe Costco is providing luxury goods for elites at a cheaper cost.
I mean, certainly the stuff that I buy, and I am a big meat eater, the meat that I buy, I get it a lot cheaper at Costco. And I can buy a ton of it and throw it in the freezer, and I save a fortune.
All right then, Matthew. But Amazon, do you own Amazon?
We don't own Amazon stock. And the only reason we don't is the way that it kind of came off the lows. We prefer to see slightly different types of patterns. I wish that we did. I mean, it's one that we missed. And I say missed in kind of parentheses. Again, it's not the type of pattern we look for, but certainly was strong. And from a customer standpoint, I'm also an Amazon customer. The idea that I can be sitting on my couch and decide, hey, there are 3 things I want, go to my phone, click on it, and tomorrow they're there. I mean, that's not a bad thing.
Amazon. I just completed a book titled Betanomics. And from reading that book, it becomes quite clear that unlike other companies that failed when they were not sticking to their core function, Amazon will not fail because Amazon has discovered a way to ensure that all of its services are integrated within the core function, and Amazon is really a selling platform.
Yeah, I mean, Amazon at this point is too big to fail. You've got the Amazons, the Apples, the Googles, the Microsofts. I mean, those companies are too big to fail. And anything can happen. I mean, look at the problems Facebook or whatever they call themselves now, Meta, is having. But yeah, I wouldn't expect Amazon to be going anywhere unless somebody just comes out and just totally out innovates them, which is possible.
Yeah, that's why Jeff Bezos doesn't take a day off. Well, he's no longer at Amazon, but he's an innovator on Amazon. Is still benefiting from the policies that he implemented. So how do you incorporate innovation into a company? Jeff Bezos created a 6-page letter. So if you're interested in pitching an idea, you create a 6-page letter and it is read by a team and they will highlight the pros and the cons. So many companies talk about innovation, but they're yet to create a structure. What's your structure?
So, we don't have a 6-page letter. What we're constantly looking at is, because we try to be innovators in the ETF marketplace. So we constantly try to look at, what do investors want? that either doesn't exist in the marketplace, or what does exist isn't that good, or what should investors want? What's coming? What should you want? What product, where if I told you, hey, we're coming out with this, you'd be like, oh, wow, I never thought of that, but that would be great. And, that doesn't exist. So we're constantly kind of having those conversations, both internally. And I also tell people on Twitter, give me ideas. If there's a use case for the idea and it's doable, it's something we'll consider. So, not only do we have the ETFs we have, we were the first to file for a series of single stock ETFs, allowing investors to go 2x long or 2x short, a bunch of different individual stocks. We also just filed for 2x long ARK. We filed for short Chinese internet. And we've got a whole other set of ideas behind those.
And this is where we're having the conversation, Matthew, because we met online. I pitched an idea.
Yeah.
And you're quite receptive. But before we talk about that idea, we're going to talk about ARK innovation, short selling, and Cathy Wood. What is short selling?
So short selling is basically where you sell shares of something you don't own, with the idea that you think it's going to go down in value, and then you can buy it back later at a lower price. So basically you're betting that something goes down versus going long something, betting it's going to go up.
And what's ARK innovation?
So ARK innovation, ARK-K, is the largest actively managed ETF out there. Or was. There are people who are converting mutual funds. I still would assume they're the largest, but don't hold me to that. They're a fund that's been around for a few years. Famously, in 2020, they were up over 100% and went from somewhere around $1 billion in assets under management to a lot more than that. They kind of topped out February of last year and have had a little bit of a struggle. Their idea is they want to invest in innovation. And, and I talked about kind of the problems of innovation. The other issue is too, one person's innovation isn't necessarily somebody else's. So, you may think DocuSign is innovative, I might not. But their whole idea is they want to invest in innovative companies. They've got a fairly concentrated portfolio, and it's going to be volatile. When it goes up big. When it goes down big.
But I must applaud Cathy Wood for being a true risk taker, and she's not losing momentum. People still take Cathy Wood seriously. I still follow her. But tell us about your fund and why it was created, because I read a headline once. Matthew Tuttle is short selling to expose the deficiencies in the ARK Innovation Fund, something to that effect.
Right, which isn't the reason we launched the fund. Yeah, there's a lot of, you're anti-Cathy Wood and this and that, and that's no. We didn't launch a fund just because we're anti-Cathy Wood. That wouldn't make a whole heck of a lot of sense. We launched it for a few reasons. So, we're sitting around, we filed for it in the summer of last year. And in the summer of last year, we saw a couple of things. We saw first that it topped out in February and, was in a downtrend. We also saw we were in an environment where it was fairly obvious at some point the Fed was going to raise interest rates. And so one of the things that we know is in a rising interest rate, the types of companies that ARK-K invests in do not do well. So we knew that. We also knew the market was overdue for some type of correction. And if that were to happen, we also know the companies in ARK Innovation are going to do worse than, say, companies in the S&P and the NASDAQ. Also, historically, I've used a lot of inverse ETFs, so inverse S&P, inverse NASDAQ to hedge portfolios. The problem when you're hedging portfolios using inverse S&P and inverse NASDAQ is, what are you shorting? You're shorting the FANG stocks, Microsoft, Amazon, Apple, Google. No one ever got rich doing that long term. So we wanted to launch SARK. A, we saw the environment being very conducive to it. And B, we wanted to create a better hedge. You know, and at the end of the day, that was the most important thing. We looked out there and we said, you know, if markets are in turmoil, the current products out there for investors to hedge their portfolios just aren't ideal. And something that went inverse RK would be a much better hedge for your portfolio.
All right, then. So now, Matthew, we're going to talk about a new idea, an ETF for the picks of prominent individuals. So Nancy Pelosi, people like Nancy, they follow her company. There's an app, Iris, it's a social media app, and app is interested in following people like Nancy. Would it be feasible to create an ETF to gauge the performance of her stock picks?
So yes and no. This is something that we've looked at, and one of my ideas is a congressional ETF. The problem I would have with a pure Nancy Pelosi ETF or an ETF on any one person. So like for Nancy Pelosi, what happens when she leaves Congress? She's no longer required to disclose her holdings. So your ETF basically goes kaboom. You don't know what Nancy's buying anymore. So I think, you know, integrating her picks into a larger congressional ETF would make a lot of sense. Yeah, and I'm not saying a Nancy Pelosi ETF wouldn't be a bad idea. I'm just saying it's an idea with a limited shelf life. Yeah, the moment she leaves Congress, your ETF is done.
Or we could extend this portfolio to prominent people, so like a Carl Icahn or Peter Thiel, not just Nancy Pelosi. And as I said to one of your associates, the shortfalls in the ETF would be mitigated because we're going to build the ETF based on the strength of both present investment and future investment. So if Peter's portfolio is doing well, the ETF will appreciate. If Peter's portfolio dwindles, obviously they're going to lose value. But if the market thinks that Peter will make some more money by picking new stocks or investing in another company, then the ETF will also grow.
Yeah, no, I think a diversified portfolio of prominent people, you know, also, you know, with the flexibility to add and subtract, you know, if people, you know, die or, you know, again, you can't access their holdings anymore. I think something like that makes a lot of sense. You know, it's been tried from the standpoint of trying to mimic, you know, large hedge funds, and with mixed results. But I think, you know, the idea of prominent people, I mean, I think that's an idea that definitely has some legs to it.
Yeah, I'm not ruling it out. And I have another idea that's, it might sound a bit crazy. Brands, an ETF for brands. So Kim Kardashian, she could be worth 1 billion, but her brand is valued at 4 billion. Don't you think that it's time for us to really marry entertainment and business? Shouldn't we be treating celebrities like shares or companies?
I mean, I think that's an interesting idea as well. Yeah.
Yeah, and I'm really serious. I'm looking forward to the day when we can go online and buy shares in, let's say, a Jay-Z.
And you know, a couple of years ago, I would have said no way. But now with kind of the rise of, you know, NFTs and, you know, again, all this stuff going on with crypto and, you know, some other stuff out there, I mean, I would assume that's something that will happen at some point.
Yeah, I'm really passionate, and I think there's quite workable. People follow celebrities all the time online. They love Addison Rae. So when you follow a celebrity to boost her brand and she becomes rich, why can't you become rich too?
I think it makes sense.
Yes,
I
it
would
makes
not be
perfect
surprised to
sense.
see it.
And there's so much demand for celebrities and their brands. So from a long-term perspective, it is highly unlikely that you're going to lose. If a celebrity buys a piece of art, it becomes valuable. So the brand is more likely to appreciate than to depreciate.
Yeah, no, again, I think that makes a lot of sense.
Yes, Matthew, maybe I'm the person who should create this platform. I think so, because I think
I think so too.
yes, I'm looking for people who share my passion, but it's something that I'm really passionate about. I'm actually speaking to some app developers, and they keep saying to me, "What about the regulations?" And I'm like, when you're an entrepreneur, you create the product, and then you worry about the regulation. I can't afford for regulations to become a distraction.
Yeah.
Yes, if we sit down and think about regulations, we're not going to move.
No, and yeah, I can tell you from doing kind of first of its kind types of stuff, it's more difficult, but regulations are not totally set in stone. I mean, you can kind of, you can innovate out there. It just takes a little bit longer and it's a little bit harder.
So Matthew, you are a successful guy. You also provide financial advice. For years, you are a well-known financial expert. Matthew, how do people get rich?
So I mean, there's a lot of different ways. For me, it's owning my own company and coming out with products that investors want. There could be just put money away, save, invest wisely. Also for me, it's investing in the stock market. For other people, it could be investing in real estate. But I mean, I think it's having a passion for something and being extremely good at it. Whether it's being in the ETF market, or whether it's coming up with a way to invest in celebrities. There are so many different ways to do it. But yeah, I think one of the key points is getting out of your comfort zone. So, not coming at life with, an employee mindset, instead coming at things with more of an entrepreneurial mindset.
Brilliant,
I think
Matthew.
that's really important.
You are so brilliant. The employee mindset. So this is the employee mindset. Go to work, get a job, and get a good pension. Utter nonsense. You cannot survive on a pension. I know people are older. It's impossible.
Yeah, I mean, and also part of the employee mindset is go to work, get a job, and have tunnel vision. So let's say you're working on the Amazon assembly line, and your job is to do one thing. All you know is, all right, I know how to do that. I don't know what happens before me. I don't know what happens after me. I don't care. I go in at 9, I go home at 5, I'm done. An entrepreneur would say, all right, I know every single aspect of the assembly line. Not only am I an expert on my piece of it, I know what happens before me, I know what happens after me. And you know what? I'm coming up with ways to make it better. And, and those are the people who stand out, and those are the people who get rich.
Entrepreneurs should create value. That's how people become rich. You become wealthy by creating value. And I love to stress that word. A job is a consequence of value creation. Wealth creation, the consequence of value creation. You're not going to get rich by dreaming about it. So
And it's not
entrepreneurship.
just value, it's being indispensable, because an employee creates value, but an employee is replaceable. If all you know how to do is one task, I can train somebody else to do that task. But if you know all the aspects and you're coming up with ways to make it better, you're indispensable to me. I can't replace you now.
And if you are working at a low performance company, Matthew, this can be an advantage, because if you're working at a company that's struggling, obviously I do expect a serious employee to produce a high quality of work, but the answer is to not complain. If the company is struggling, it's going nowhere, obviously you're going to have free time. So what should you do with your free time? Use it and be entrepreneurial. Don't complain.
And learn.
Exactly.
Learn about investing, whether it's stocks, real estate, whatever it is, learn about that stuff.
Matthew, there is an assumption that people get rich by trading stocks, not really by investing. Is this true?
There is no one right answer in the stock market. I think what you don't want to do is do everything. So figure out what works best for you. I mean, there are a bunch of people who got rich being long-term investors. I don't have the patience to buy a stock and hold on to it forever. I need to trade in and out of it. So for me, it's being a trader. But, if you tell me, hey, Matt, I'm picking up some good companies and I'm just going to hold on to them forever, I'm not going to argue with you. Just be good at that or be good at trading. Don't try to do a little bit of everything.
And when should we learn to minimize the hustle? So because of the nature of the modern economy, people tend to talk about the hustle and having a side job. But based on what we're saying, one has to be indispensable and create value. And under some circumstances, the side job can become detrimental to professional and entrepreneurial growth if it is not creating value. So when should you really cut the hustle?
Well, so, for a lot of people, that kind of side job is what eventually they're going to end up doing, but they don't have the capital to do it full time. So, I think that's a great concept. If you're, working in something that's not your future, you've got an innovative idea, but you don't have the money to quit your job and do it, then yeah, have the side hustle and, do it in a less risky manner. I think that makes a ton of sense.
Side also less risky manner to sense. Well, Matthew, brilliant conversation. We're wrapping up. But do you have an opinion on YouTube? I don't think we're maximizing YouTube's full potential. And again, I'm a crazy guy. I think that at some point, YouTubers should be doing IPOs because if you're a YouTuber, you have a brand and brands have value.
Yeah, the whole entertainment and media sector, just like everything else, is changing. And so, something like what happens in YouTube, especially if, they can supplant TV to an extent, I think there's a lot of great content out there. And yeah, I agree. It's just tapping the surface at this point.
Matthew, don't you see what I'm doing? I'm getting you out of your comfort zone. I want you to invest in brands. Don't you see it?
I see it. And again, I have no problem going outside of my comfort zone. We do that all day, every day.
Yes, and then I'm going to create an idea that's really scalable, and you're going to create a VC firm, and you're going to give me money because the idea is going to make us a lot of money.
I've got no problem with that.
Yeah, so yeah, speaking to you has been a pleasure, Matthew. I'm going to share this interview, and it was just awesome. To be rich is to be glorious.
Yeah, thank you for having me. This was great.
Yes, bye, Matthew.
All right, bye-bye.